And therefore, let's bring in Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Mihir, I hope you've managed to have a good night's rest. It was a roller coaster day yesterday. But to weigh in on everything that's happened, I mean, the US recession concerns on one side, this whole yen carry unwinding on the other side, and where we are. Are we past the worst?
Good morning, Surabhi. See, are we past the worst is a very, very broad question, I would say. But I would say that yesterday's fall was not a reason to sell. And today, if the market goes up 1-2%, would not be a reason to buy. Because ultimately, what we need to keep in perspective is the fact that over the last few weeks, the absolute confluence of Goldilocks kind of tailwinds that we had are kind of reducing or slowing down. So a few weeks ago, we had the US economy on a roll with the Fed changing its stance to a little bit of neutral to maybe even a little, dovish. We had the Indian central banks do what they've been doing, in a sensible fashion. And we had continued retail flows and some pickup in FII flows over the last few weeks. So it was a combination of the fact that US and global growth is a tailwind. India, anyway, growth was expected to pick up after the monsoons, and retail flows are supporting the market. I think that situation has changed a little bit, as you mentioned, because of the sharp reversal of the yen carry trade. My view is that this trade has been building up ever since 2020, 2021. So it's been almost 3 years of this easy money, borrowing in yen and investing in all sorts of risk assets. That trade has been building up over 3 years. So I don't think it's going to unwind in like a day or two. It will have a bit of a trickle-down effect or ripple effects throughout various markets. For example, while we were looking at stocks yesterday, even the cryptocurrencies were down sharply. So you really don't know where exactly all the flows have gone, where all the borrowed leveraged money globally has gone. So it's not going to unwind in a day. So as I said, yesterday was, of course, a culmination of a lot of factors, and the kind of moves that we saw, 3 sigma, 4 sigma kind of moves that we saw, probably will not repeat too often. But that does not mean that every problem or every leverage trade in the world has been unwound yesterday. So as I said, just because the markets were down yesterday was not a reason to sell. Just because the markets are up today may not be a reason to buy. So in the medium term, I think we should stick to the overall investment thesis for Indian markets, which is that through thick and thin, at least for the next few years, India will continue to remain amongst the relatively fastest growing economies in the world. Demographics, etc., we all know are on our side. And plus, more importantly, we are probably already past the peak tightening stance by most of the central banks. So while, of course, Japan hiked, but they had different reasons for that because of the currency issues. But most of the central banks are now in a cutting mode. So after the sharp Fed hikes that we saw ever since 2022-23, now, of course, we are talking about a cut cycle. So I think even if the US slows down, the Fed will start cutting rates actively now or in the next few quarters. And that should continue to give a buffer to the market. So if there is gut-wrenching volatility, I would not react negatively and use that as an opportunity to buy. But just because the markets are down on one day doesn't mean I go out and put all my money in one shot. So I think level-wise, as you did mention, Mahesh also mentioned that valuations, of course, were a bit frothy in some of the pockets. So I think we need to stagger out our investments level-wise as well as time-wise, with the clear view that the Indian economy is relatively amongst the better places to be.
Valuations were excessive. India's market cap to GDP had hit 150%. And the last time we were at that level was in 2007. And we know what followed, the crisis which precipitated. So we are not looking at 1-2 day index moves across the global markets, which are impossible to predict. But what about for the next 6 months? Is the outlook for equities looking a little less rosy because US growth may falter, whether or not we get into a hard landing or recession? But growth is now being questioned in the US. Slowly, this yen carry trade is unwinding. That trickle-down effect will take place slowly. So what's the outlook for global equities for the next 6 months?
See, volatility is going to remain heightened for sure. which means it's on both sides, right? You'll see whipsaw moves both on the downside as well as upside. So it's very, very crucial to keep fundamentals and valuations in mind, stock-specific fundamentals and valuations in mind. And I think every carnage or every sharp move in the market does give opportunities, brilliant opportunities, because our canvas, luckily for India, is so high that you can always pick and choose stocks. So because I'm sure everybody has a list of stocks which they missed, and if there is a correction, a sharp correction in the market, you should keep that list ready and be prepared. But very clearly with a 1 to 3 year type of a time frame. I don't think the volatility that has begun is going to end very soon. So we have to continue to live with the volatility for the next few months, and make sure that we own good quality stocks that we always wanted to own, and stick with them for at least 1 to 3 years.
1 to 3 years, that should be a horizon if you get in now. Take that point, Mihir. But do you see, because of the events that have unfolded in the last 2-3 weeks, do you see market leadership changing? Because through thick and thin, over the last, I think now 18 months, if not longer, leadership has remained with PSUs, with CapEx, economy-facing stocks, whereas private banks, FMCG, they've been laggards. Do you see that changing at all?
Certainly. I think in some of the segments, which of course you mentioned, there is a lot of action happening. So there's no denying the fact that these are likely to continue to be growth sectors for a while. But in the last few months, we had too many thematic funds being launched, probably chasing a limited set of stocks, and valuations in some pockets because of that did go up significantly. So I think some of the segments which are, as you mentioned, domestic facing, like banks, financials in general, which are non-lenders, including insurance, wealth management, capital market linked stocks, those should provide a good buffer, and there are certain stocks and business models in that which can see secular growth. So I think some of those ignored sectors which have been underperforming for some time may come back into the limelight. As we mentioned, as we discussed, we are probably past the peak of the tightening cycle. So gradually you should start to see all the issues with deposit growth, etc., for the banks and NBFCs recede, and that should ultimately translate into not only volume growth, that is credit growth, but it should also translate into better margins over the longer term. So I think in the next 6 months, we should get a good tactical entry point into some of the lenders and non-lenders. So that's one. Second is discretionary has been quite volatile. And I think that in the last 3 years, while we have seen pockets of growth, like say cars recovered quite well, two-wheelers are beginning to recover. But if you look at the overall consumption and discretionary space, our volumes on an aggregate are only a little above or at levels which were there at the pre-COVID level. So I think the penetration story has really not played out in some of those discretionary names. Whether you talk about auto ancillaries, or you talk about eating out, and all those kind of things. So I think there is still scope for the broad macro theme that we always want to play, which is increased penetration, increased prosperity, etc. So I think consumption also within that discretionary can offer good opportunities in a correction. And third, of course, I think we have been talking about pharmaceuticals, which are now coming out after a long period of issues with the FDA, etc. And you are looking at companies which are now doing not only basic API kind of work, but the CRO and CDMO space is also becoming quite exciting. So a lot of stock picking in sectors like pharmaceuticals. So I think domestic link sectors, some of the pharmaceutical names look good. I continue to believe in the physical asset creation story. So all those names in the real estate infra, all the domestic names should continue to do better than the global facing names like IT, metals, energy, etc.
Okay, very helpful advice, Mihir. Thanks very much. Plenty of food for thought there for investors as they look at some tectonic moves over the last couple of hours in global markets. Thank you so much for joining in. We look forward to the next call. We'll take a break on that note. Come back on